All right. Well, hey, welcome traders. Uh, Welcome to followmetrades.com, my secrets to trading success. And looks like a lot of people are already logged in. And I appreciate everybody being here on a Saturday, you spending your time. And I'm going to do my absolute best to give you some really, really good information here. Um, in the Zoom webinar, there's a chat box. Make sure you can find that because as we go, I definitely encourage you, ask whatever questions you have and I'll take them on the fly and answer them. I want you to get as much benefit out of this session as possible. So locate that chat box and to make sure you can locate it and use it, go ahead and type in where you're calling in from. It's always fun to see. We typically get people from all over the world. And right now I am sitting in Port Townsend, Washington, which is north of Seattle on the Puget Sound, right across the water from Victoria, BC. And it's northwest, it's early April, and guess what? It's raining. Hey, so hey, we got Mitch from Atlanta, Al from Knoxville, Bill's down in Southern California, Gunnar in LA, Britt's calling in from Sweden, so it's evening there. Al's from Charlotte, uh, Liliana's from UK. All right, a couple folks from Europe. And we're just going to let a few more folks type in. Hey, Paul, good to have you there. Bert's from Colorado. All right. If you hear seagulls in the background, that's not a sound effect, that's real, because I'm sitting about 20 feet from the water, and they're flying around doing their seagull thing. But it's pretty nice. My wife and I snuck away for the weekend here to Port Townsend, and it is nice. Nan's calling in from Tennessee. Charlie from Trinity Alps. Wow. So we got people from all over. Excellent. Excellent. Okay, well, let's jump in here and get started. So, my secrets, my trading secrets to success. There's some overriding concepts here in trading success that I think are important to touch on. And the first thing is, you just got to keep it simple. It's easy to overcomplicate the markets and trading and an approach to it. And that can just lead to paralysis, frustration, all kinds of things. So I've learned over the years, you just got to keep it simple. The other thing, if you're going to be successful, you just have to control risk. And I'm gonna give examples of how I do all these things, but you got to control risk. And Al says, will the seawater hurt your computer? Well, I'm in the room, so I'm looking right out the window. Okay, and you got to have objectivity, right? You got to eliminate the role of emotion in your trading. Now, we're going to experience emotion. We can't prevent that. But what we can do is limit the effect that it has on our trading. And that it really comes through having a trading system and some rules that we follow objectively, right? And that we take trades based on objective criteria rather than, wow, I think this company's great or it's going to be great, right? Speculation. So if we can keep it simple, if we can control risk and we can be objective in our trading, we're going to go a long way towards being successful. And this is a true statement, and this is that consistent and respectable profits are absolutely possible in the market. Right? It's true. You can do it. What's not true is that it's easy and you're going to get really rich really quick. And I'll bet many of the people calling in here today have seen advertisements and promotions talking about how easy it's going to be, how rich you're going to get, how fast it's going to happen. And that's not true, right? It sounds too good to be true. It ain't true, right? But we can make consistent, respectable profits in the market. And I want to share what I've been doing, what an example of that. So here's my yearly results going back several years. You can see there's some variability in it, but year after year, I'm making respectable profits, and I'm consistently beating the Dow and the S&P 500. And this year, I got to get this updated. We've actually bumped this number up just a little bit. We're on track to have, a typical year. And if you're interested in looking at the website, this table summarizes the year after year after year results, but all these buttons show you all the detailed trades. So I believe in complete transparency. So if you look at last year, right, I list every single trade that I took, what my win ratio was, and more importantly, what my payout ratio was. And one of the things you'll notice is that my winners are bigger than my losers. And we're going to talk more about that in detail and how important that is in a trading system. But I just wanted to share that, I'm getting these results. Customers who are following along are getting similar results. So it's possible that we can make good, respectable profits. But let's don't expect, to swing for the fences and hit home runs on every time at bat and all other kinds of metaphors. My results are verified. They're audited by a third party. I give them my brokerage statements. They look at what I post on the website, and they confirm that what I say I'm doing, I'm actually doing. So I think that's important. We can make consistent, respectable profits. We're not going to get really rich really, really quick. And I say it's not easy. Learning and developing a system takes tremendous discipline. But once you get it down, it doesn't take too much effort if you're going to follow that system. I'm going to talk about some live trades here. I'm going to show some of my favorite current ones. But just a disclaimer: hey, there's risk in the market, and I'm not a financial advisor. I'm sharing what I do, but whether any individual acts on that information, that's your decision. Okay. And so just introduce myself really quickly, because I know there's some folks on here. Some people on the line are existing customers, and I'm glad to have you here. It's always good for a refresher, maybe pick up something new. But some folks, have never been on a webinar, haven't met me before, so I'm glad you're here. So I'm Dean Jenkins, founder of FollowMeTrades.com. I've been investing in trading for over 25 years. And it really started, I got interested when I went to work for Intel Corporation in 1993, and they gave us incentive stock options, and we could buy stock, employee stock purchase program. And I joined at just the right time in 93. And, that was really the beginning of the .com rise, and Intel stock increased dramatically. I saw the power of stocks and options. During that time, I went and got an MBA from the University of Washington. And for quite a while, I was a fundamental trader, which means, I was into analyzing companies and earning statements and ratios and all this stuff to teach in business school. I got mixed results. And, through that whole .com thing, I had some good wins and had some losses, but it was mixed. And it was frustrating because, you got a good company with good earnings, good management. They should do well. And then, the next report would come out and it wasn't good enough. And so the stock would tank, or, you had a company with problems and the report would come out and the thing would go up because it wasn't as bad as everybody thought. It was really frustrating. I totally gave up for a while. In 2007, I go, this is just too hard. This is too frustrating. And so I just pulled out and, sat on cash. And it was really lucky. And that was just pure luck. I didn't have a crystal ball at that time. I don't have one now. But, I missed the crash. So I didn't lose money in the crash. But after 2009, when things started recovering, I just saw the potential, and I couldn't stay out. So I got back in, and I remember I bought Bank of America at $5 a share, and I went to 12, about a year. And that was awesome, but I was stressed out because I didn't know what to do. Should I sell it and take all my profit, or is it going to go higher, or am I going to give it all away? And I'm sure you've all been in that position. Even on a winning trade, it can be stressful if you don't have a plan, right? And then if you're in a losing trade, well, that's even more stressful, right? What do I do? So I got really interested in technical trading in about 2010. I made a lot of mistakes, and bought a lot of indicators and went down a lot of wrong paths. But in 2012, I finally settled on my current trading system, and I started getting consistent profits. And I learned a lot. Having a mentor was an important part of that process. And 2015, I launched this company. And it really started, as I started getting consistent results and some profit, I networked with other traders, and pretty soon people were asking me, hey, if you're going to take a trade, would you let me know ahead of time? I might want to, follow along on what you're doing there. And it turned into a business where people subscribe to the trades I'm taking. And so that's just a quick introduction of who I am. I also, I got an MBA from the University of Washington. Later, about 5 years ago, I went and got a master's degree from NNU in pastoral ministry. And when I'm not trading, I'm a co-pastor at church here in Washington. And, I'm called to ministry, and that's awesome. And I get to serve in ministry and then not take a salary from the church. I make my living trading and run and Follow Me Trades, and then I get to serve the church. So that's kind of living the dream. It's really cool. So there's my results again, my website, followmetrades.com. And so again, feel free to ask questions as we go along. I really want to make this the most value for you I can. And here's what we're going to do. I'm going to explain my trading system, really how, my secrets. I'll share you my secrets with you about being successful. And, part of that, as I mentioned, is just keeping it simple. I'm going to walk through how I analyze a chart. I'm going to share some great trade candidates with you that I think are good right now. Some of them I'm in right now. And then I'll look at some stocks you're interested. Be happy to, at the end, take a few symbols that you're tracking, maybe, stocks or companies you're thinking about trading, and I'll give you my opinion based on the analysis technique. Who knows, I might just love some of your ideas. I often get great trade ideas just like this. And then at the end, I'll extend an offer if you're interested to follow along with my trading on an ongoing basis. So stay with me if you want to get the most out of this. And Walter, thank you. All right. So I love quotes. I keep a book of quotes and read it all the time, right? It's important. I think it's good to hear what, really smart people have had to say over history, right? But about success, Benjamin Disraeli said the secret to success is to be ready for your opportunity when it comes. And I think that relates to trading. A lot of times we're waiting for something to happen, but if we're waiting and we're ready and we have a plan, right? Then when the opportunity comes, when there's a particular pattern or setup or direction in the market, we can capitalize on it. So I like that quote. And the other one is from Louis Pasteur. And in the field of observation, chance favors the prepared mind. And again, that's having a plan, being ready, knowing what you're looking for, and recognizing it when you see it, and then be able to act on it. Okay, it's important to make a distinguish between trading and investing. Today we're talking about trading. There are different approaches to the market. Investing is typically, you buy and hold long term. It's the Warren Buffett thing, right? Or there's other methods. It typically involves fundamental analysis of companies, looking at the earnings, their management, their products, all that stuff. It includes diversification, asset allocation, and it can incorporate yield in addition to growth, where you're looking for high dividend stocks, as well as you want the price to appreciate over time. Those are typically the features of investing. Trading is typically shorter term, and you can trade on different time frames. Sometimes intraday, that's called day trading. I don't do that. You can hold trades a day or two, a week or two, a month or two, but trading is typically shorter term, and it's looking for just moves in the market, a swing up, a swing down. Trading typically uses technical analysis, which means looking at chart patterns and using what are called indicators. And you can profit from moves up and down. Typically investing, people may hedge against a move down, but their objective is to get into things that are going up only. Where trading, we can make good profits, whether the market is going up or whether it's going down. So here's some things that I've learned on my journey to becoming a successful trader, is that to be consistently profitable, you got to have a plan. And these three elements of a plan are just essential, right? You got to have great trade setups. You got to have an edge. You got to have a high probability outcome. It doesn't have to be 100%, doesn't have to be 90%. It's got to be greater than 50% that the outcome you're looking for has the probability of making it. You got to have a great reward to risk ratio, and that means if what happens, the probable thing from your trade setup happens, that you will make more money if it does happen than you will lose if it does not happen. And I'm going to show some arithmetic for this, some ways to control it, and that leads to risk management. We have to control the downside. We have to recognize that every time we go buy stock or options or something, if we take a position in the market, it could lose. Even if there's a high probability outcome, there's no guarantee, and it can lose, and you can lose money on it. So if we can control that to a small amount, to an acceptable amount, we're going to be way down the road to being successful. And then we have to be able to manage a trade once we're in it. We have to know what to do. I talked about my example with buying Bank of America. It went from 5 to 12. And I was still stressed out because I didn't know what to do. I didn't have a plan. So you got to have a plan, and we're going to walk through what I do in each of these areas. Okay, let's look at a stock chart first for just a minute before I get into my tools. I'm going to bring up Apple. So here's the daily chart looking back, a couple years at the stock for Apple. Everybody loves Apple, right? There's a story being told on this chart. And so the price of a stock, it's an auction. People are buying and selling, and when they bid the price up, the price goes up, and when they bid it down, it goes down. So it's an auction. And when you think about Apple, it trades millions of shares per day, and there are tens or hundreds of thousands of market participants. There's big institutions, mutual funds and insurance companies and retirement funds trading, and there's individual investors like us, or traders like us, trading the shares. And it's the collective response of all known public information about Apple that dictates price. And price is the only reality in the market, price and volume. So, earnings and, iPhone 10 and, China trade, all that stuff is reflected in the price. The collective market response is the price shown here on the chart. And you want to know if there's new information about to be released that's going to be disruptive, but everything you need to know about Apple and its stock price is shown on this chart, because again, it's the reality. It's how the market is responding to all the known information. And you can see the story, way back here in 2016, it was just going up and down, up and down, up and down. And then, new information came out, or the response to existing information, for whatever reason, the market participants drove this up, in a very impressive trend. And then late last year, it changed, right? Sentiment of the market participants changed, and they drove the price down from, over about 230 down to 140. That was a big drop. And then it changed again earlier this year, and the market participants started bidding it up. Okay, so there's some positive, kind of growth. People are bidding it up. Some pessimism came into the market, and then the optimism returned. So there's a story here. And again, this is the reality. And we can use some tools to analyze this price movement and determine, when did this uptrend end? When was there really good proof that this big move down was going to happen? And we had proof of that. I'm going to show you the tools I use. And then how did we know that downtrend ended and that the up move was starting again? Now, there's no certainty. There's no free lunch on Wall Street. There's no guarantees. But we can have probability on our side. And I use some tools to do that. So let me show you what they are. So I use Dow theory, which is created by Charles Dow back in the late 1890s in a series of editorials in the Wall Street Journal, the paper he founded. And those have all been published in a book called Dow Theory. And one of the things he talked about was trends. How do you know when an uptrend has begun? How do you know when it's continuing? How do you know when it's ended? And his theory still works today, and it's pretty simple. So I use that. I use Ichimoku Cloud. And I'll talk about that a little bit. And I use a very, very simple version of Elliott Wave, if you've heard of that. I'm just looking for impulsive or corrective moves, shifts in from optimism to pessimism back to optimism. Overriding criteria in my trades, I look for high probability outcomes. I want there to be a better than even chance, right? Then I'm going to be right. Higher the probability, better. And I look for great reward to risk. The amount I would make if I'm right is more than the amount I would lose if I'm wrong. Because you can be wrong, and you do lose some money on trades. So we just try to control that. All right. I know some folks are logging in. Locate that chat feature, ask questions as we go. Definitely happy to answer them on the fly. Okay, here's Dow theory, and what Charles Dow said back in 1890s. It's still true today. Was, hey, an uptrend is a series of higher highs, higher lows, higher highs, higher lows. As long as when price pulls back, and it does, because if you look back at that Apple chart. Right? Price does not move in a straight line. It moves in a series of what? Higher highs, higher lows, higher highs, higher lows. As long as these pullbacks don't go below the prior low, you still got an uptrend. Okay, so as long as we have higher highs, higher lows, higher highs, higher lows, we have an uptrend. Downtrend is lower lows, lower highs, lower lows, lower highs. As long as these moves back up don't go above the prior lower high, still a downtrend, as long as it goes on to make new lows. That's pretty helpful. It's simple, but helpful. So an uptrend begins when you get a high, higher low, it does not go below here, and then a new high. Price goes above here. You go, oh, looks like an uptrend began. And then it's an uptrend until you don't put in a new high, and price pulls back below this prior higher low. Downtrend, low, lower high, new low. Downtrend begins. Lower low, lower high, lower low, lower high, lower low. Oop, didn't put in a new low, pulled up, went above the previous lower high. Looks like it's changing. And lo and behold, we can see it on live charts. Right? So I'll show you here. I'll get my pen out on Apple. This was just kind of going sideways, But then here we had a high, higher low, high, higher low, high, right? And it just continued all the way up. And then, uh-oh, we got a low, which is normal, right? But it did not go on to a new high. It didn't go above here. And then it went to a new low. At this point, we had a really good predictive thing happening just with Dow theory saying this trend, this uptrend's probably ending and a downtrend's beginning. And we can predict how deep that's going to go. And then at the bottom, we had a high, higher low, new high. Oh, looks like it's going to head up. It's going to continue. That's pretty cool, I think. Kind of simplifies it, helps you read the story of what is going on. So I use that in my trading and in analyzing charts, and I find it very helpful. Okay, so back to my slides. Okay, so that's Dow theory. I use that. I use Ichimoku cloud. It's this shaded thing here. It's this green cloud going up. It's this red one going down. Okay, it's like moving averages. If you're familiar with moving averages, they're calculated. A simple moving average calculates the average closing price looking back some number of price bars. Standard, a lot of popular ones for daily charts are the 200, the 50, 20, the 8. So it just takes last 200 price bars, takes the average closing price, plots a line, and that becomes a dot, and that dot becomes a line, and that's your moving average line. They're helpful. Ichimoku cloud uses 3 different look back periods and then plots this cloud, kumo in Japanese. What it shows you is when price breaks, from one side of the cloud to the other, that is a strong indication of a new trend. And then it predicts support areas. So as price goes up, price pulls back to the cloud, up, pulls back, pulls up. And then you can see price typically breaks through when the cloud gets really thin. So the thicker it is, the stronger the support level, the stronger the trend. And we can see that on Apple, right? We had a nice uptrend, right? It broke a couple times, but never really, we got lows, but we didn't get that 3 thing that I was looking for, low, lower, high, new low, right? And then it resumed. But when we got this signal up here, low, lower, high, new low, look how thin the cloud was and the price broke. So that gave us additional evidence that this downtrend was beginning. So that is really cool. And Charlie's saying, hey, Thinkorswim has it built into their studies. Yeah, so I'm looking at TradeStation. It's a free standard indicator, Ichimoku Cloud. I use proprietary settings on mine. I do it a little bit different than the factory settings. And I'm going to show you how you can get that here toward the end. Okay. So I use Ichimoku Cloud, and I find it helpful. And people often ask, what's the one indicator? What's the one thing you look for, Dean? And I go, there is no one. It's the collection of, I try to build a case like a prosecutor would, build a case for a conviction of, a prosecutor would look at, physical evidence and, witness statements and alibi and motive, and they try to build a really, really strong case for a conviction. And we do the same thing here. We look at a variety of analysis techniques at the story being told on the stock chart by price, and then try to, find setups that have all the indicators pointing the same way, or most of them, building, again, a strong case for what's going to happen next. So I use Ichimoku Cloud, and then I use this simple version of Elliott Wave. So interestingly, the guy, Ralph Nelson Elliott, who developed this, was working on it. He developed it back in the 30s, and that is the same time period that Goichi Asada, a guy in Japan, was working on Ichimoku Cloud. Don't know if they knew each other, but I think it's interesting that these theories developed back in the 30s still are absolutely relevant. So what Elliott Wave says is that there's a collective investor psychology, a crowd psychology, that moves between optimism and pessimism in natural sequences, waves, series of impulsive and corrective waves. Elliott Wave typically looks like this: 1, 2, 3, 4, 5, and then there's a correction afterwards, ABC. I only try to trade 3, sometimes 4, and then 5. Right? The impulsive moves are the correction. If you've been exposed to Elliott Wave, you may be rolling your eyes. There's a lot of people who get just overly weird and complex about it. I keep it super simple. All I'm looking for is a big move, a correction, and a continuation, like Apple, right? If I were to do a wave count on Apple, and some people who do their wave counts, Elliotticians, as they're called, get all weird. This is easy. 1, 2, 3, 4, 5. This is 3. This is 4. This is 5. Each one of these was very tradable, right? Very tradable. And we had clear evidence using our indicators. We could have got in here, we could have got in here, and we could have got in here. So that's pretty cool. The other thing that Elliott Wave does is it uses Fibonacci numbers, which are some cool numbers developed by a mathematician back in the 1400s. It's a number sequence that goes 1, 1, 2, 3, 5, 8, 13, 21, on and on and on. You get the next number of the sequence by adding the previous two, and then the ratio of numbers in those sequence to other positions in the sequence give you what is called the golden ratio, 0.618, and that golden ratio appears everywhere in nature. It's in snail shells. It's in, you know, the shape of spiral galaxies and hurricanes and shorelines. And it's interesting how complex systems respond to Fibonacci numbers. Well, the market's a complex system, and once we have this super impressive move up, and we see the confirmation of a downtrend, we can predict that the correction that is beginning, because we saw evidence of a correction beginning with a low, lower high, new low, price went under the Ichimoku cloud. These blue lines are Fibonacci levels. They are 31.8 to 61.2. Sorry, 38.2 to 61.8. So we can predict with reasonable accuracy that this correction, once it's confirmed here, is going to go down into this region. And guess what? It did. Okay. And the other cool thing we can do is once that correction is over and we see evidence of the next up move beginning, which is here, high, higher low, it broke through the cloud into a new high. Oh, it looks like an up move is beginning. How high will that go? We can use Fibonacci. So this is a Fibonacci retracement measurement. We can use a Fibonacci extension, and we can measure these same points and then this retracement level, and we get a predicted region for the next, what's called wave 5, and the prediction here is between 228 and 282, right? No guarantee, but high, a way better than even probability, much greater than 50% chance that this is really going to happen. And this is based on current information. If something new happens with Apple, good or bad, right? This could change, but with all the current known information and what's kind of expected, we would have a probability of Apple moving up into this region. So that's pretty cool, I think. Right? And again, this is all objective analysis rather than just kind of a gut feeling about what I think is going to happen with Apple. So those are tools I use in my trading. And let me get back to the slide set here, okay? So risk management, this is essential, even more than what indicators and setups you're looking for. Risk management is the number one thing that will either help you be a successful trader if you use it, or will ensure that you are not a successful trader if you don't. It's axiomatic. Right? Using risk management will not guarantee that you'll be successful. Not using risk management will absolutely guarantee that you will not be successful. Right? So you got to have it. And what risk management really is determining how much you're willing to lose on a trade, and then controlling that so that the worst possible thing, if it loses, you don't exceed that level. Now, most people look at a trade and their expectation, their thought process is about how much am I going to make, and that's the reason we're doing this, is to make profit. But I think the first thing as a successful and as a disciplined, mature trader, when you look at a chart and you're thinking about taking a trade, you go, how much could I lose? How much am I willing to lose? And then make sure you control that so that if the worst thing happens, right, that's all you lose is what I call a pain-free level, an amount that would not be a setback. And I use 2% of my account as that guideline, right? I don't want to lose any more than 2% of my account on any given trade. Some people confuse that and say, oh, you only put 2% of your capital in any given trade. No, that would actually limit your results, right? So I have a formula, and it's simple math, it's arithmetic. And so that, the first thing we got to do is establish on a chart where our stop would be. So let's look at this Apple chart, okay? And we're going to zoom in here a little bit tighter. And I talked about Dow theory and analyzing a price trend. So if we look at this move up, we've got a, I'll just kind of draw it rough. It's hard to draw with the mouse, but I'll do my best. Right? We got higher high, higher low. I'll kind of take it to here, higher low, higher high, higher low, and it's heading up. And it looks like it might have just made approaching that, right? So Dow theory said we have an uptrend as long as this continues, even with lousy drawing, right? And if price, goes on to this high, and if it comes down and goes below this prior low, what that means is that uptrend is over, right? That it failed. So I would want to be out of the trade if that were to happen. And so what I do is I set a stop level. I go, if price goes below this level, I want to close the trade. I do not want to be in it anymore, right? Because my thesis about an uptrend going up to this target has failed, right? Didn't make it. It's a loser. So I just want to get out at that point if price goes down there. And what I do is I figure, here's my entry price, right? Here's my target inside here, right? I take this minus this, and this is about 197. This is sitting here at about, 182 or something. And I just subtract it. Say 182 from 197 is, what? 197 minus 182 would be 15. Okay, so $15 a share. I'm going to lose $15 a share if I'm wrong. Then I go figure out how many shares to buy, and I divide that into the max I'm willing to lose, 2% of my account. That tells me how many shares to buy. So let's get some real numbers and let's do an example of this. Okay, so let me. I'm just going to draw a line here, current price, and I'm going to draw a line here at this level that I've determined as my stop. And by stop, I mean the price level that I would exit the trade. I was just get out. Now some people, go, well, I don't like using stop orders, market orders or whatever, market makers hunt them. Whatever order you use, it doesn't really matter. The point is to have a predetermined planned exit point that tells you the trade is failing and you want to get out. So whether you place a market order or not, that's your, it's your money, you do it your way. But I think having a predetermined exit point and then acting on it is essential. So let's take these numbers. I'm going to put them on a spreadsheet and demonstrate how this math works. Okay, so here's a quick little spreadsheet I built with this math in it. And so this is a long position. And so let's say we're trading with a $50,000 account, and I've got this 2% risk. I'm the most I'm willing to lose on the trade is 2% of my account. So my entry is 197.36. Oops, better get the decimal in the right place. 197.36. My stop, the exit point, is 184.66, and my target is up here at this green line. Let's call it 228.19. I'm using the low end of that target zone to be conservative. Okay, so it says the initial calculation, if I just take that math, take the entry minus the stop, divide it into $1,000, which is 2% of $50,000, say, hey, go buy 78 shares of Apple. And then we go, oh, but that's going to cost $15,000. $15,000 is that's like almost a third of 50,000. That's an awful big position for that account. So what I do is I constrain that to 15%. I say, I'm only going to spend 15% of my account on any given trade. 15% is $7,500. It's rounding. So it says this trade, the appropriate number of shares for this trade is 38 shares. Why do I constrain it to 15%? Because there can be bad news. Tim Cook could have a heart attack and Apple all of a sudden gaps down $50 a share, and I could lose more than what I planned at the stop. So I control that by only taking 15%. Okay. So in this case, what it says, hey, go buy 38 shares. If you hit the stop, you are going to lose $482. If you are right, you're going to make 2.5 times that, 2.43 to 1. right? So you're going to make, you know what, 1,400 bucks on the trade if you're right, versus what you would lose if you're wrong. That's how I approach every single trade. Is I look at what am I willing to lose, how many shares, how much capital should I put in it, and I want to make sure that my reward to risk ratio is very positive, that I could make more if I'm right than I would lose if I'm wrong. Everybody with me so far? Let me take a breath, see if you got any questions to type in. Quick drink of coffee. Okay, I don't see any questions coming in, so I'm just going to keep pressing on here. All right. All good, says SP. Thank you. Let me show you another spreadsheet that I'm a spreadsheet geek, I admit it. But I think it's helpful to use some arithmetic and demonstrate some concepts. So this is a Monte Carlo simulation that I've put together. Just using statistics and taking trade parameters that I'm shooting for, and it predicts what's going to happen. So you can see what I got here is I'm using the random function in Excel. So I got 50 trades laid out here. And so every time I cycle this spreadsheet, it's going to take 50 trades. And based on the parameters I put in, you know, how many of them are going to win. So I put in a 50% win ratio. So for this simulation, it's going to say the trades have a 50% chance of winning. Now it's going to vary back and forth because the market has a degree of randomness, right? There's patterns to it, but it's not perfect, so there's randomness. But I say, if my max winner is $2,000 and my max loser is, this is based on a $50,000 account, so the max loser is $1,000, right? And I can control this by the trades I take. I only take trades that have the potential to be bigger. So let's say that I take trades that have the potential to be double the loss. And then if I actually do get a winner in this simulation, it's not going to be $2,000 every time. It's going to be random between $100 and the max win, 2,000. If I take a loss, it's going to be between 100 and 1,000. So what do you think happens if I cycle this? Okay, so I'll cycle the sheet, and you can see every time I run it, here's the P&L out of the sample, right? So out of 50 trades, that one won 21,000, this one 18,000. Here's a really, really rare case where it was a losing thing. Almost all of these end up winning, right? So there's a degree of variability to it, but the feature here is that if I can keep my winners double my losers, even if I only win half of my trades, okay? Even if I only win half my trades, I'm going to be pretty consistently profitable, and I'm going to try and do better than this. What if, you know, I can win 60% of my trades? Well, I'm never going to lose, and the amount I win just goes up. It's dramatic. It's pretty dramatic. Let me catch up with some of the questions. Joe says, seems like setting a stop loss should be on something meaningful, support level, previous high. That's exactly what I was demonstrating, Joe. So on this chart, I set my stop at this low, right? Higher high, higher low. So my stop is at this low. Some people use what I call arbitrary. Because, well, if I go down 500 bucks, I'm out. Or if I go down 5%, I'm out. I think that's a mistake, because that could be within the average true range of the movement of price in the trend, and you could be getting stopped out when these pullbacks are just normal price movement. So I do set up my stops at legitimate support levels. Okay. And Charlie's saying, hey, your losers winners about equal this year. And again, you know, at 50%, we can be profitable trader. And even with a 50% win rate now, historically we're doing better than that, and you know, I continually try to do better than that. But there's a degree of comfort. You know, it takes the pressure and the stress off. If you, even if I just win half my trades, I'm going to be profitable if I manage them right, take the right ones. Okay. And Chris is saying, why use 100 for the? I mean, we're using the actual, you know. I think this is a legitimate range of the amount to lose, the amount to win in the simulation, right? We're not winning or losing the max every time, but some range between a floor and the max. Let's do this. Let's say, what if you were a world-class trader and you had a 75% win ratio, but you really didn't pay attention to reward to risk, okay? So, the amount you win is equal to the amount you lose, but you're a 75% winner. Surprisingly, you'll be okay, but there's going to be periods where you take a loss, right? Where you'll end up with a loss. Of course, it's not coming up this time. And you'd be surprised that there are people who actually trade systems or their behavior leads them to have winners that are smaller than their average losers. So even like, let's do this. A lot of people like trading credit spreads. Would you believe that the numbers on a credit spread are typically like this? And there may be some people on the line who disagree with me, but they are. It's true. If you take a loser on a credit spread, it's going to be about 3 times the size of the winner. So even if you're at 75%, right, you've actually got, for the most part, a losing trading system. And if you've done spreads and you experience that, yeah, I've talked to a lot of people who thought that was going to be the ultimate system, and turned out to be very disappointed about it. So again, the point of using that is, if we have good reward to risk, we don't have to win every single trade. In fact, we can lose half of them and be okay. And of course, we try to win more, right? But so the key there is to absolutely control risk on every trade, have it calculated, don't let it be bigger than expected, that's acceptable for your account size, and then only take trades that have high potential. Okay, so trade management. Trade management, you can get into a great trade, and with good risk management, you can still lose money if you don't manage it correctly. And the number one mistake I see people make in their trade management is they get into a good trade, they have good risk management, but then they get a little bit of profit and they jump out because they get worried. It's like, wow, I went up $500, I don't want to give it away, so I'm just going to close the trade. But if it's going the other way, they'll let it hit the stop, close at the kind of the max loss end. So what you do is you just cut your winning trades, in half or less, and you kind of guarantee through that behavior that you're never going to have big winners. You got to let winners run, right? And a trade management system will show you how to do that, right? So you take profit strategically. You can even add to the position, but you want to stay with the winners for as long as possible, right? Let them run to their full potential so that reward to risk ratio that we insist on up front is realized. Because if you just jump out at the first tick up, you're going to miss on a lot of profit, and you're going to kind of guarantee that you're a break-even trader. So I hope that that math made sense for everybody. So let me catch up with the questions here. SP says selling credit spreads is very scary. Here's that selling options of what most people make money on. I hear that too, and it's I've studied this to death, and I thought for sure for a long time I was just missing something. I'm now convinced, right? I actually talked to a guy who's been teaching options for like 40 years. And he said, back in the 80s, actually selling spreads really, really worked good. He goes, until electronic trading and the volume and the speed of the market increased, he goes, here's a guy who's taught option strategy for 40 years. He goes, selling spreads is a losing proposition for the reason I just talked about. The reward to risk ratio is terrible, right? You can get a bunch of winners. I call it picking up nickels in front of a steamroller, right? You can get a bunch of really small winners and one loser come around and wipe them all out. And that's just a drag. So I don't do it. Yeah, we're going to wrap this up at the top of the hour here. Someone was asking how long is this going to go? Yeah, I want to respect your time. So we're going to wrap it up at the top of the hour. Okay, so we're getting some agreement here on credit spreads. Trade management. So I trail my stop. Remember, I set my stop at a legitimate support level, and then as price moves higher, high, higher, low, higher, high, I trail my stop up. I take profit as I cross key Fibonacci lines. take a third off, but let the final third run into the target zone. And I just keep trailing my stop up as new support levels are formed, and I let the final portion of the trade then stop out at the final stop. We can't call the top, but we can tell when the trend has changed, and that is when we want to get out. And Britt is asking, could I share my Excel sheet? Sure. Anybody wants those, just send me an email. I can't do it here on the fly, but send me an email, and I'm putting my email in. There you go, dean@followmetrades.com, and say, hey, could you send me those spreadsheets from the webinar? I'll be happy to do that, share those with you. Okay, so that's trade management. Trailing your stop according to not 10% or 5% or some fixed arbitrary trailing stop level, but trail your stop at legitimate support areas, take profit, but let the final portion of the trade run up to the target, right? So again, the overriding concepts in being successful in trading for me are just keeping it absolutely simple, controlling risk, and then being objective, following your rules, having a trading plan. So I'll show you some of the trades I'm in right now. And so I'm in 6 positions. Okay, I'm short CME, COP. I'm long Baidu, Curus, Delphi, and Diamond Offshore. This is the current P&L column over here. This is Attractus and Radar Screen. And so you can see in 5 out of 6 positions I am in profit. And most of these trades I have been in a very short period of time. We just took a couple days ago. We wrapped some trades up, initiated some new ones. So, this is based on a $50,000 account. So if I were to close these trades at this moment, and again, we've only been in these a couple days for the most part, and this is a $50,000 account, we'd be up $750. So, and you see, not every trade wins. COP is underwater for now, but it's not over. So all these trades look pretty good right now. Not all. Let me show you. So Baidu, we got in, and you can see, why did I get into Baidu, right? Well, this was the impulsive move down. This is a correction that we are trading, right? And we saw down here, high, higher low, new high, breaking above the Ichimoku cloud, positive momentum. I got in here. My stop is at the support level. My target is up here at a potential resistance area. And this is actually a Fibonacci retracement zone. I think I took the lines off, something like this. Yeah, you can see the Fibonacci retracement zone, so I'm being conservative. This is about a 2.5, 3 to 1 reward to risk ratio. We're in it. We're in nice profit. Could you still get in it? Yes, but not for much longer, because the risk at that current stop level is approaching 1 to 1, but you still got a little bit of time. So Baidu could still be a good entry. And I will trail the stop when we get a new support level. So it's got to pull back and then reverse up, and then I have a support level I can trail my stop to. Curus, small cap drug maker, interesting company. We got into this. We took a half position because these can be volatile. So it's a small cap drug company, but it was a really nice setup, and we're in some nice profit. We got in at 215. It's at 228. We got a target at 3. So in terms of percent profit, that's pretty nice, 6.5, and that was in 2 trading days. Delphi, of course, a bigger company. They make high-tech stuff for cars. And again, big, huge move down. This is the correction up, high, higher, low, heading to new high. Right, we got a target up here. This one still looks good. It's got this high to overcome, but I still think it will. I still think the momentum has shifted. So that's a nice looking long trade. And Diamond Offshore, we've been in a while. It took a little while to get going, but now it is off to the races. And here's the pattern we saw, huge move down. Here we go, low, lower high, new high. We got in here. We had to sit through this. The initial stop was here. Now we've trailed it up to here. This one still has room to run up to the target. So DO looks good. Okay, so those are some charts that I'm looking at that look good right now. I've given you my comment on those. So at this point, hey, do you have any charts? I'll take about 5 that someone would like me to offer analysis on, and then we'll start wrapping things up. So Walter would like to look at Texas Instruments, TXN. So Texas Instruments looks very similar to Apple, doesn't it? It had this big run up. It had a correction into this Fibonacci zone. It is clearly higher highs, higher lows, higher highs, higher lows. So it's heading up. And the target on this would be, put our Fibonacci extensions on. Up above 132. You do have a prior consolidation area. Maybe you would want to see it break through that. You want to check earnings. You know, we're starting the earnings season. But just from a pure Elliott wave standpoint, this looks pretty nice up into this target zone. Okay. Al would like AKS. I'm not going to get to them all. Sorry. So AK Steel. So obviously this huge move down. We were looking at this one. That's why there's some colored lines on here. I would want to see it. So we got, you know, this move off the bottom, high, higher, low, high. So far, but it had a nice pullback under the clouds. So let's let it prove itself, you know, get back up to a new high. Then it might look good. And at this point, you'd have your stop here. There may be a new level coming. Ray wants shop. Shopify. Shopify has been in an impulsive move up. It's dramatic. This actually is a 3, 4. This looks like a new 3. So you wouldn't want to chase this up. And it actually looks low, lower high, new low, like it is forming a correction. You want to let that break the cloud, maybe go red on your oscillator here. So there might be a correction coming on Shopify. So I would not try to chase it higher at this point. James, Canopy. We've traded Canopy a couple times and we did well on it. It is in a tough consolidation right now. So we had this big move up, pretty good correction. It's trying to get going, but you can see this kind of sloping channel. It has got to break out of all this noise. And we say about 49.03. If it can break through all that, then there might be a shot up to 57.96 or above. Ollie's saying on average you only trade 5 shares. So these are the current positions. These are the ones I publish to my subscribers, and then I'm taking to my own account. We're currently at 6. We'll move anywhere between 4 at the low end to 10 at the higher end. It really just depends on the market and the opportunities and stuff like that. So we're kind of in the middle of the range right now. Okay. Greg wants JD. And again, I apologize. There's not time to get to all of them. JD, big impulsive move down, perfect correction right into this Fibonacci retracement zone here. So now the next move we would not try to take this long. It was good down here as it broke out. Too late. Look for the next down move to come. You look for low, lower high, breaking down through the cloud. This is the 200-day moving average. If you can get down under that, you probably got a shot at it. So I'll do one more, and then that's gonna be it. UTX. We were watching. We wanted a short on UTX, and it just didn't set up, and then it took off up here. So I was so glad I didn't take it short. Right? We were looking at this move down and a correction, looking for it. If we saw this low, lower high, we go, oh, let's let it break down here, and it didn't. It shot up. So UTX. There was some news about. I think there's news it's going to break into 3 companies or something in the market like that. I'll let that settle out. I wouldn't chase this move up just yet. Ollie, no, I only trade stocks on the U.S. exchanges. Quite a few Canadian stocks are listed on U.S. exchanges, but I just trade on the, a lot of Chinese stocks or whatever, foreign, there's ADS, ADRs on the U.S. exchanges for foreign companies. We trade those. And ETFs if they look good. Okay. Let's go ahead and start winding this down. Okay. Did that. Finding trades, Great trades. There's 8,000 stocks on the U.S. exchanges, and you add the ETFs, man, it's a big pile of hay to sort through. Finding a great trade, can be like a needle in a haystack. I've showed you some good ones that we worked on in the trading room and through my scanning techniques. A handful of good trades, and we do that every day in my trading room. Again, three things are essential. These are my secrets, right? You got to have great trade setups with a high probability outcome. You got to manage risk, and you got to manage trades well. Do you guys believe that? Do those make sense to you? Do you believe having those elements in your trading plan will help make you a profitable trader? Maybe raise your hand. There's a little hand up button, or type in yes. See if I get any agreement. Yeah, hands are going up. Absolutely, people agree. Okay. How many of you like the trades? You're kind of excited that the ones I just showed you, the ones that I thought were good. There's some pretty nice trades there. I think we're going to get some winners. Maybe you're a little unsure about how to act on it, how to manage those trades, right? Maybe you feel like this dude. I just presented a bunch of information in almost an hour, right? It's like, wow, that was a lot, right? So I'd like to spend a few minutes going over a special offer, right, related about what we just talked about and how you could be following along with me if that interests you, right? Finding great trades is hard. Once you find them, you need a plan, right? You got to find the setups, then you got to do the risk management, then you got to do the trade management. You got to do it all. I've been doing this for years. We're getting good results. My customers are happy. And so, what's that worth? On average, I just showed you, trades we've been in a couple of days, right? On a $50,000 account, average monthly return about $2,000. Over 10 hours per month of detailed trade consultation in the trading room and some live chat feature forums that I provide. To go buy that from a top-notch trading educator is not cheap, right? One-on-one consultation, you get that when you subscribe, and then ongoing education and tools that I provide. That stuff can all add up if you go buy it discreetly, right? Easily $5,000 from most places, right? I'm going to offer you all of this. Great trade setup, risk management, trade management, detailed trade consultation every month, one-on-one consultation, education and tools. You get access to all that and winning trades, and it's not going to cost you over $5,000. The list price of my stock and option pick service is $127 a month. It's about $1,500 a year. It's great value at that price. For you today, here at this session, you can take a trial for 30 days for $37, and then it would be $97 a month after that, a 25% discount, and that's 100% money back guarantee. Take the trial, give it a shot, and for most people, they go, wow, I'm in, right? Some people, I just didn't have the time, I didn't understand it, it didn't fit with my philosophy. That's all right. 100% money back guarantee on request, no questions asked, no hard feelings. I just think that's the way to do business. So I'm posting that link into the chat box, right? Or you can hit that link that I just put in the chat box, or if you like using your phone, you can text secrets to 484848. So what do you get with this service? Here's everything you get. The watch list of trades. We go over it every day. Folks that sit in the trading room or join me in the evening chat sessions once a week. I show them the trades that I'm watching and waiting for, right? You get alerts, email, text message when I'm going to get into a new trade. You get the exact details of every trade, the entry, the stop, the target. Most of the trades can be traded with shares. If you like trading shares, you just buy the shares, go short the shares. Or if you like options, I also provide an option contract corresponds to the trade. I like options. You get alerts, email, text message when I'm going to make a change, right? Move a stop, take profit, close the trade. You get access to the live trading room, which is, it's actually an hour at the market open. You can attend if you like, it's not required. We do record it, there's a recap. Weekly live chat sessions Wednesday evenings at 6 Pacific, 9 Eastern. One-on-one consultation. So when you sign up, you get a link to my calendar, you can put time on, we can talk. I can help you get off to a good start, and I'm there if you have any questions down the road. I give you risk management tool, option trading tools and training, ongoing support and training. I'm here to help on an ongoing basis. I know some of my existing customers are online, and if any of them want to type in a comment, I get very good feedback that people really appreciate the level of support that we provide here at Follow Me Trades. And there's more. I showed you the Ichimoku Cloud. If you sign up during this session today, I've got a course. it's called East Meets West. It's how I combine Elliott Wave and Ichimoku Cloud. It's my proprietary settings. There's a written study guide, there's training videos, and a printable trade setup cheat sheet, right? If you take the trial today, the 30 days for my stock and option picks, I will include the Ichimoku Cloud course for free. And the list price on that is $247, so that's a good deal. So you just click that link or text secrets to 484848. And Bill just put in a nice testimony there. Thank you. Answer need to know question raised. Do we need to be on the computer for trades as well as for options? I will send a text. It will go out email. I'll send an alert. It will go out via email, and you can opt in for a text message to your phone, so you can just get the alerts. And then, you know, if you got your brokerage app on your phone, you can place the order there, or you can get over to a computer and place the trade. You know, we're in between 4 to 10 positions a day. We take about 2 to 3 trades per week. So this isn't day trading. It's not like you got to be at your computer all day, right? The amount of time you need to spend, you know, if you just want to execute the trades and follow along with me, should be less than an hour a week. Easily less than an hour a week. If you want to come to the trading room and learn and participate, you know, that's an hour a day. So, you know, somewhere between there. SP, I went to a Vantage Point seminar last weekend. I do use Vantage Point, which is artificial intelligence software. It has proven to be very helpful in my training, and they're a high quality company. Very impressed with them. So I was there last weekend teaching. I do use it, and we show how we use it in the trading room. It is not required to buy, but it's helpful. Again, when I said earlier, I build a case. I don't look at any one indicator. I look for all the indicators to point the same direction and increase the probability of the trade. Jen, yeah, the Ichimoku Cloud is absolutely available for TOS. It's free on your platform, and I give you the settings for it. Yes. All right, so special offer today. You know, you can take the trial, 30 days, $37, and get the Ichimoku Cloud training included if you take that offer before I hang up today. And again, I'll post that link, or you can text secrets to 4848. So that really is everything I had. I'll sit online here if you got any other questions, you know, about the offer, you're trying to get signed up, or any other general questions. Happy to take them. But hey, thanks. You know, you spent some time here with me on a Saturday. I know this is valuable, and I hope you found something useful in it. And again, thank you very much. And I will hang out here on the line again, answer any questions. And yeah, I hope to see you in the trading room Monday morning. Have you join and be part of it. All right. Hey, thank you. Got some nice comments coming in. Appreciate it. Thank you. Always say, hey, do you have any class in person? Working on that. Working on that. So we're putting together a potential in-person thing where we'd go on the road to a couple different cities, but it's not there yet. All right, thank you. All right, any other questions? Great. Sanjeev's asking if you're in a position for a day trade, how to determine stops. Well, I showed you how I do it. I use, and it works on any time frame, right? You look at the support and resistance areas defined by price action. Yeah, if you do that text, BJ, the link will be sent to your phone. Yeah. And Sanjeev's asked, how do you watch the closing hour and come up with a position for the next day? That's not part of my strategy. It's I don't day trade, Sanjeev, and I look at price action, and I don't think the next hour is going to tell you what the open's going to be. All right, Larry. Yeah, I'm glad you're interested, and we definitely can talk.